Hello everybody, Jackson here from the Wealth Squad. Today talking about some undervalued dividend stocks. We're going to go over three. First one is Verizon. You can see Verizon has had a tough couple days. This is the 1 year chart. Go to the 5-day chart. It's gone from 54 to 52. That doesn't seem like much. However, Verizon doesn't move very much. Their beta, which is actually compared to the market, like a 1 beta is it trades with the market. Below 1 is it trades less, it's less volatile. Above 1, it's more volatile. So Verizon, as you can imagine, is very low volatility, right? It doesn't move very much. You can see the past 5 years, it's gone from 42 to 61, right? That's nothing. But anyways, last year you could see it's gone from 59 to 52. Just had their dividend payment of 64 cents a share. And that's per quarter. And you can see the past 3 months are basically just the past couple days, right? You could see the massive sell-off on Verizon. Massive for its stock, right? 3% is not massive at all, but you can see on this chart it's huge. It's giant, right? So Verizon is pretty undervalued here. Let's check the 5-year chart. You can see it's this the lowest it's been since COVID, since that recovery or that crash in March of 2020. We can expand out here. You can see the RSI is getting to that negative territory, not negative, under 30 on the 5-year chart. On the 1-year chart, it's already there. Year to date, it's there, and probably you can see on the 6 months, 3 months, 1 month, 5 days, it was there, and of course 1 day is kind of trading out of it, but it's under that 30 RSI, right? So if you're looking to buy Verizon, now's the time. This is the chart. Let's check the fundamentals. Let's go on finviz.com. Get past the ads real quick. You can see a 2.98 PEG ratio. That's not very good. That's actually pretty bad. And you can see a 9.7 forward PE ratio, which is very good. Now, the thing to love about Verizon is actually a dividend yield, 4.81%, and that's paid per quarter. You can see it was just paid. Earnings are slowly growing, if at all, and you could see it has been doing well, right? You can see the performance year to date. The beta, like I was talking about, 0.43, moves barely with the market. But yeah, overall, just not doing too hot recently, and that's when you want to pick up stocks, right? You want to be contrarian. You want to buy stocks when there's blood in the streets. So this may be that pick for you if you're into that stuff of dividend stocks and slow moving, better than inflation type stocks, right? 4.81% per year, almost guaranteed. So next off, we're gonna go with Amgen. Now we talked about the stock a while back when it was right around here at 220. Unfortunately, it did not hold this support line. As you can see, you could kind of visualize the support here. Let's full screen it. And it broke past that, so now it's heading towards that $200 mark. And that's good for anyone that wants to pick up the stock, right? Because the cheaper it gets, the more you could buy with your money. So it really is selling off pretty hard here, just like Verizon. No real support resistance lines until the 180s. You can see the volatility isn't very much there as well, as it's only gone from 160 to, or I'm sorry, like 260 from 130. So it's double in 5 years. 1 year, it's kind of gone nowhere. But the dividend payment is also there. You can see the RSI is very low, although not under 30 on the 5-year chart, nor the 1 year, nor the year to date, nor the 6 months, or 6 months kinda. But that below 30 mark is when you really want to buy stocks, because that's the definition of oversold. So Amgen's another good stock if you're looking to pick it up. Pick up a dividend stock. You could see 260 is a good resistance, and that 220 price is right here, and that did not hold. It broke past it, so we don't know where it's going from here, right? It could deal with all the COVID support and resistance, just like Verizon. So let's check out the actual company. Go to FinViz again. So we could see earnings doing the same thing, not growing very much, even shrinking. PEG, a high PEG, but a low forward PE ratio. And you can see the actual gross margins, the profit margins are pretty good. You can see Amgen does manufacture drugs. It's a healthcare company. So if you don't want to deal with healthcare, then maybe look elsewhere. But general healthcare in this case may not be too bad as a business. Although it hasn't done very well lately, it does not seem to be massively overvalued by any point. In fact, with a 3.4 dividend percentage and a strong PE ratio of 11.5, does seem pretty nice, right, at this price, 206, maybe even 200, or we could get for less than that because there's no real support resistance anywhere below here. So just watch out for Amgen as well. And lastly, we have PNW. Now, PNW has been getting hit just recently, just like the other stocks. Since June, it's gone from 88 now to 66. And you can see it just was below that 30 RSI on the 1 year. And the 5 year had a green day today, up 1.4%. Which you can see right up here, 1.4%. So, you know, it's still cheap compared to what it was a couple weeks ago, a couple months ago. So don't think this day changes much. Although it does seem like you have a dividend coming up, yeah, right along with the earnings. We'll review the dividend later, but you could see PNW is just as hurt as the other stocks, and it's encountering that COVID support. So just like the other two stocks, they're all touching that COVID support. So that may be worth something to watch. Maybe you could get for cheaper if you just wait for the 60s instead of 66. But let's check out the actual company, or at least the numbers behind the company. So it's a utility company. You can see right down here, regulated electric in the USA. The valuation isn't too high. So you can see right here, PE ratio, although the PEG, which is the price, or this over the earnings growth, is very high. So that may be worth watching, not in a good way, right? You want a low valuation, and a low valuation comes with a low PEG. So if that's not there, then maybe you want to wait for a cheaper price to compensate or something like that. But you can see also a strong dividend of almost 5%, worth $7.8 billion, did $3.7 billion in sales. 500 million of that is in income or gross profit, or just profit in general, right? But so PNW is just like the other stocks in terms of being oversold or borderline oversold and encountering that COVID support. So if you're thinking that the COVID is going away, these stocks will eventually solve their problems, then you might as well buy them, right? Because if you look behind the actual stock and into the company you research are safe and not going anywhere, then they're definitely worth investing in, right? Because they're cheap at these prices, under 20 PE ratio across the board. So yeah, that's the video, guys. Just 3 stocks to watch out for: Verizon, Amgen. You can see Verizon encountering new support since COVID. Amgen manufactures drugs, same thing. And PNW, which is an electric company, same thing. So 3 undervalued dividend stocks, all paying a nice yield and rather undervalued in this overvalued market. I hope you enjoyed this video. If you did, please press like and subscribe for more videos every Monday, Wednesday, Friday. And until the next day, I'll see you later.